Hi, everybody. Hi, Piyush. How are you doing?
Hey, Julien, good. How are you?
I'm good. Thank you. Thank you for having the conversation with me about the market stats for the real estate market for March 2025. Very happy to be able to bounce some information that were delivered today. So it's nice and fresh. So I will do um, a presentation based on charts that will present the supply and the demand, because as we know, prices depend on those two factors for the most part, and as well as a little bit about interest rate. So
Mhm.
that's where you come in expertise, and we'll be very eager to find out what to expect in those interesting times.
Indeed.
All right, let's me start it off. Okay, so right now we're looking at the chart that presents the number of sales, which can be translated as the demand over the last 20 years, and has been adjusted on a 12 months average. All right, so we are over here. In other terms, we are on the lower end of the chart. Okay, long story short, we don't have much volume. Okay, and if we try to kind of do a little bit of history, that was the frenzy in 2015-16. Then that was after the implementation of the stress test, and then we witnessed a significant decline in activity. Then it went back up. Over here, that dent was COVID. And then after that, the rest is history, with significant increase in volumes, and then increase of interest rate, which translated in a decrease of volumes. All right. So now we have been going through a couple of years of low volumes on the market, and now with the tariff, we were trying to kind of rebound, and now with the tariff from our friends down south, the market is now also kind of not so active, which put against the evolution of the supply, which is the total inventory for all property types, detached, attached, including condo, townhouses, for the Greater Vancouver. Okay, that total inventory, so we are here, has been going through a very, very significant increase, right? So we are back at 2019 level. So we haven't been through that type of inventory for the past 6 years. So that is something to be underlined. And as Adam Smith would say, the price is being guided by the invisible hand between the supply and the demand. So how is the price going? So the price is holding it up. As we can see through these charts. We have been going through some minor decline from the top. Okay, so to what extent, that is my big question, to what extent those price levels are gonna hold it up? I think it really depends on the seller's project, and people that do have to sell for some reason will have to make some compromises in terms of price. Right now, either something significant happens at the central bank level. Piyush, I hope you will be able to tell us more about that, where in order to respond to those tariff, the central bank lowers the overage rate significantly, so it makes money cheap for buyer to take the advantage of such low rate. So then they go and complete their real estate project, or interest rate remains pretty much acceptable, not necessarily the deal of a lifetime, but pretty acceptable, better than what it was for a couple of years. But sellers should not expect any increase in price, or at least as much as we've seen in the past couple of decades in the Vancouver real estate residential market. So my takeaway from those charts is that there is an angle for potential buyers that are serious about buying to identify a property with good bones, not only from a structural perspective, but if you're buying in a strata, as opposed to, like we've seen in the past, buyers having to jump in a strata because prices were just blowing up. I think there is a great opportunity here for buyers to kind of identify great properties in good strata, in good standing, or single detached homes in good neighborhoods with maybe better structural aspect to it, right? Fundamental aspect to it, right? So acceptable interest rate, more inventory, I think comes in with a bit more of negotiation power from a buyer's perspective. So the highlight from the report delivered this morning that was sent out to my client base was like, it's a buyer's market, but missing buyers.
Yeah, pretty much.
Yes. So, I mean, on my side, I see some activity. I do have some activity on the listings that I am presenting the sellers for. I'm working with a couple of buyers. We're out there. We're trying to again identify, okay, from the pool of properties available that is matching the search criteria, what are the ones that do present some fundamental aspect to it, such as can be the exposure, it can be the height in the building, depending on what you favor. It can be the overall square footage, or it can be the year of construction. It can be many things, right? But there are some. If you can extract the value, if you know the value that is working for you, there's definitely more properties to choose from. But I will, before I'll give it to you, Piers, I will say this: in this type of market, when buyers have been waiting for their break to actually have the upper end, which it doesn't happen as much in Vancouver, because usually sellers do have the upper end, right? So buyers, they have this frustration, when the market is blowing up, there's buying frenzy and it goes over ask and bidding war and all of that. Now, and I've seen that actually in 2018. So if we go back to the chart here, so over here, all right, when the number of sales was significantly low, okay, I was going back to my buyers that were basically waiting for their break. And I was like, okay, the break is here. Usually buyers that are waiting for the break wait for longer.
Yeah.
Do you see that too?
Yeah. It's it kind of translate how the stock market works. Everyone's trying to catch, and what they say, they're trying to catch the falling knife. Everybody wants to buy it on the low, right? Like, let's wait. Price is going to come down. Or, no, wait. Interest rate's going to come down. So it's always, everyone's trying to find the bottom of the market. And when, let's say, when they do find it, and everybody jumps on there, and guess what? Everybody jumping in the pool at the same time, you push up the price. You kind of end up doing the counterintuitive thing. It's when you find a good deal, you like it, go for it.
Yeah, it's because if we look at the price evolution, okay, when did that market actually bounce back? So here we don't see it as much from the median sales price. It didn't really decrease, right? Okay, so if we take the example of 2018, really what happened is that we had the implementation of the stress test. So basically that shaved 20% of purchase power from buyers utilizing a lender. And the price were correcting, okay? So as we go down in price, people are like, okay, I want to buy at the bottom. It's like what you're saying, right? Catching a falling knife. But then when it starts to reverse, it reverses and it goes back up in that particular case. And if we look at the past, since 2008, 2009, the financial crisis, like from once they bounce back, like really, okay?
Exactly. It's always bounced back higher.
Yes. Oh, that one was, so this one was the correction from the implementation of the foreign buyer tax, okay? Summer 2016. So people were like, oh my God, prices are gonna fall. Well, they did correct, and then boom, they bounced back up. And then same story here, and same story here.
Same story with COVID, and then it's probably going to be the same thing for this whole situation we're in right now.
So long story short, like now we see that a little deep. When is it a good time to get in before it bounces back up and you've missed your window ultimately? We don't have that answer. And
we'd be billionaires if we had that answer.
We should remind the viewers that this video is not intended to give any financial advice.
Yeah.
But to help
this is for educational purposes only.
Educational purposes, right? We're just conveying information.
We're only showing you what the past trend has happened. Past trends do not necessarily mean that's what's going to happen in the future. Because as you can see with that the green line dipping down, we don't know how much further it's going to go down.
Indeed.
Right, so we could be at the bottom already, and then let's say spring market starts, and then everything just shoots right back up, or because of this whole tariff situation, it might go the other way. So we don't know. There's so many other factors that are involved.
Yes, indeed. But so far, how are the interest rates? So the different interest rate, right? Please educate us about the different types of interest rate, because we usually talk about the Central Bank of Canada interest rate. Can you tell us a little bit in details what kind of rates we should take into consideration?
Yeah. So before we get into the whole rate situation, I always tell people, don't look at the rates. Let's look at what's behind the rate. What dictates the rates? So when we're talking about fixed rates, so there's fixed rates and variable rates. Fixed rates are completely dependent on the bond yields. The bond yield that dictates the fixed rates the most is the 5-year Canada bond yield. I have a chart over here of the last month, and we can see the volatility that's happening on the bond yields. And during the high inflation era post-COVID, we saw everything, all the prices, everything go up, and interest rates went up because inflation was so high. So all the central banks were all around the world to rein in inflation. They increased their overnight rates, and that gets reflected on the bond yields as well. And then the bond market also independently trades in the market. And when the 5-year bond yield drops, the cost of money it becomes cheaper. So then usually it takes a while, usually gets reflected in the following week. Then we see a little bit of dips in the fixed rates that the banks will offer. This chart right here shows the volatility that's in the market that's happening specifically due to the whole tariff situation that the United States is imposing on Canada. And let's face it, now it's going to go around the world. As of today, the Trump administration has done reciprocal tariffs for every country that's out there. So we don't know what the future repercussions of it will show up in these trends. The estimate is it's because of tariffs, the cost of everything is going to go up. So if everything is going to become more expensive, then it means inflation is going back up. This is the CPI, the inflation rate as of this morning. Consumer price index is at 2.6. So usually the Bank of Canada tries to keep it between 2 and 3%. This is where the whole Bank of Canada policy rate comes in. If inflation gets too high, then the Bank of Canada increases its rates. So, for example, the prime rate. Prime rate right now is sitting at 4.95.
Okay.
And we have a Bank of Canada announcement coming up this month. If this inflation
can I stop you for a sec?
Yeah.
So you just said the prime rate 4.95.
Yes.
Okay. We just look at the 5-year bond rate, which was 2.
Let me go back.
2.58. Okay. And now the Central Bank of Canada rate.
You're talking about the policy rate, the 2.75.
2.75.
Yeah. So yes,
that goes back to what I was saying. Like, when we talk about rates, okay, really, which are the ones that we need? What is the best guide? What is the best rate that if we had to only know one rate, which one should it be? The 5-year bond rate, prime rate, Central Bank of Canada rate?
So essentially, from the consumer point point of view, you don't need to focus on these rates, these things as much. The whole point of me showing this is it shows you what dictates your rates. At the end of the day, it is that financial institution that's offering you the mortgage. They determine their own rates. So to answer your question further, so this 2.58 that you see here in the chart, that's what the market rate is for the bond. That's what it's trading at. So it's like a stock. Prices go up and down. People are buying and selling bonds every day.
Is different.
Now, that policy interest rate, that is 2.75. That's a key overnight rate, because we hear that a lot, and a lot of folks, I get a lot of clients calling, hey, the rate is now 2.75 or something like this. So it means the rate's that cheap. I'm like, no. What that is, it's common, because you know what, it annoys me when even news, when it comes on there, and they're telling the general public, here's the overnight rate 2.75. The general public doesn't need to know about the 2.75 rate, because that's the cost of the fund. That's that's the rate that the government of Canada will sell the money to the financial institution, to the banks. That's the bank's cost.
So
that's what I'm saying. So that part, consumers don't need to know that.
All right, I have a question.
Yes.
So, okay, Central Bank of Canada publishes their rate a couple of times a year, something like 8 times a year, something like that. That dictates the cost of money to institutionals, right? Banks and so on. That also dictates your variable rate. Okay.
I will get to that. Yes.
Okay. The 5-year bond rate dictates your fixed rate,
Correct.
and that is more of a financial market negotiation between big players, right?
Mhm.
So where does the prime rate come from?
So the prime rate is the rate that everybody, all the banks, and every, you know what, they don't have to be the same. So it's the rate that most banks come to an agreement with, that this is going to be the prime rate. And the Bank of Canada sets that rate as well.
Okay.
So right now the prime rate as of today is 4.95. And all the institutions, financial institutions that are in the business of giving out loans, they don't have to choose that prime rate, but most of them do. But like, I know a few lenders who have their own prime rate. They'll take the 4.95 and they'll add 0.15 to it. So you
Okay.
might have a bank that their overnight rate is, their prime rate is 5.10. So, but the prime rate is that's the number that everybody should know who wants to go a variable rate.
Okay.
Okay, because when the Bank of Canada, when they make this announcement, like, oh, are they increasing the prime rate, are they dropping the prime rate? If you have a variable mortgage, that's when you have a direct link to it. Because if Bank of Canada drops it by 0.25, so your mortgage next month will be less. It depends, if not to get into too deep into that, like if some people have a fixed payment mortgage, then what's going to happen is that you're going to be paying more towards principal rather than interest. If you have a adjustable payment, it means if the rate has dropped, then your monthly payment will drop,
Okay.
and vice versa. If it goes up,
You pay
you're
more.
paying more interest, or your monthly payment goes up. So that right there is what has a direct effect to consumers, is the prime rate. And the prime rate can be also not just for people who want to purchase homes, also for businesses. If you want commercial lending, usually commercial lending is prime plus. Cost of borrowing for businesses is a lot more because the risk is a lot more.
All right. So going back to those rates and the inflation,
Yes.
where you were at before I asked you that question. The inflation, you say that the Central Bank of Canada likes to keep it between 2 and 3. So right now we're at 2.6, right? And the way it works is that the more it goes up, the more you increase your overnight rate so that the inflation is being contained. Okay. So are you saying that right now the Central Bank of Canada is in a good place in terms of inflation? The inflation is pretty much under control. So if they would want to decrease the rate to kind of boost the economy to face those tariffs, is available to them, or not so much?
So that's what they had been doing the last few consecutive meetings. If you see in the image over here, you can see that February inflation rate was 2.9. You had these other indicators, 2.9, and then we have CPI inflation 2.6. The unknown that we have right now, to further expand on your question, for going forward, because of the tariffs, the increase in general consumer goods, we're going to see an increase in prices. So that it means inflation is going to go up, because you probably noticed that the cost of grocery has gone up. And you go,
Yes.
right?
It's outrageous.
Right. So they're doing certain things. So like as of April 1st, here in British Columbia, we're at, they got rid of the consumer carbon tax, because federally that has been brought down to zero as well.
Yeah.
So that now that is something that's going to help consumers, because gas prices is where, it's one of those things that people look at.
It's
House
a fixed
prices,
expense.
gas.
You know you're gonna go places. You know you're gonna get your
Exactly.
tank filled up. So
Right. So they're doing certain things that'll help ease the pressure. So then that way, the Bank of Canada possibly doesn't have to react and start increasing interest rates again. So in this situation, if inflation goes up, Bank of Canada hopefully will stay steady. Maybe we don't expect a drop anytime soon. If these other things that in the economy will let off the pressure. So the consumer carbon tax is at zero right now. It's still in legislation, still not
Yeah.
removed. And we're going through an election right now. We don't know who's going to come in power. And, you hear things about they're going to move the consumer carbon tax into the industrial carbon tax. So if it's getting moved from one hand to the other, what kind of effects going to happen on the overall economy?
Yeah.
So we don't know all those kind of things. And then certain announcements that I've made recently on purchases up to, we don't have the final number yet, between $1 million and $1.5 million, no more GST when you're purchasing a brand new build, right? So that right there, that's 5%. That'll make a huge difference.
Yes, those new rules need to come into effect.
Yeah. So here's here's the chart over here explaining to you, giving you from a little bit before October and up until today of the inflation. So over here on the red, we have the median, and on the yellow line over here is your total consumer price index. So you see a little bit of dip here in the beginning of January, and then mid-January it just shoots right up.
Mm-hmm.
The total CPI. I think that's when the whole trade war saga sort of began. So
There was also the federal tax, Christmas tax.
capital gains tax.
No, you like Trudeau. He had like some Christmas tax waiver where there was no tax on specific items, and by mid-January, this basically tax waiver went away, so things got more expensive.
Yes. GST. You're right. GST was removed. So we see. So guys, I think it was removed for November and December. Was it right?
And a bit of January until mid-January. So I think.
Okay, you're right. I totally forgot about that. So that's where maybe that's part of the reason that of the dip. But overall, we know that the cost of things were improving. Supply chain issues were getting resolved. So the overall cost in the economy was starting to come down. So part of that factor can be attributed towards that tax holiday, towards the GST, and it going away and things getting more expensive, and there's a bunch of other things going on with we have several wars and everything going on as well. So overall, the world economy affects what Canadian economy responds to.
Mm-hmm. So right now, your call is that mortgage rate. So actually, I saw a stat going by this morning that in Alberta, new buyers or new people contracting for a mortgage were hoping for a fixed rate to the range of 65%.
Mm-hmm.
So the fixed rate right now, so if we take like a 3 years or 5 years, what are we looking at?
So it all depends on, are we looking at a CMHC insured mortgage, or are we looking for a conventional mortgage?
Okay, so depending if you put 20% or less.
Yeah, if you're putting less than 20% down, more than 20% down. There's also a little bracket in the middle where it's called an insurable. If you are under $1 million and 65% loan to value, you can still have your mortgage insured.
And you get a lower rate, but I think it we talked about that. I think it was yesterday or 2 days ago.
Yes. Yeah.
Where, but you need to put 35% down.
That's
Which
correct.
It's a minimal amount of potential buyers that do have this amount of cash available.
Yeah. So it's perfect for those folks whose renewals are coming up, and they have 25 years or less amortization. Properties values are below $1 million. For them, it's a very good option, and the good part is the insurance is paid by the lender and not by the consumer. Because
Okay.
if you get the CMHC insurance, if you go that route where you're on a purchase less than 20% down, the CMHC insurance, default insurance, is built into your mortgage payments, so the consumer pays for it.
Yes.
So there's many different options. So because of that, if the default insurance is there or not, the rate can be much cheaper, or if it's a conventional, it's a regular mortgage. So if it's a conventional, let's go with it. If it's a conventional mortgage,
Conventional meaning insured?
20% down.
20% down. Okay.
20% down. So you're in the between 4 to 5% range, because there are many other factors you have to look at: mortgage amount, credit score, the nature of your job, and where you're buying the property. So those kind of factors are involved in the determination of your interest rate. And like we talked about the bond yield, if the bond yield on that particular day goes up, then the cost of borrowing goes up.
Mm-hmm.
And vice versa. And that's where a little bit of insight, that's where us mortgage brokers do, is when we keep an eye on it. And if I know that day bond yield has dropped, I ask for a discount.
Nice. Very nice. Okay. So assuming that mortgage rates so far are not going to have a significant swings either up or down, and because the inventory is going very big levels, we can assume that prices will, best case scenario, hold, and to some extent go down.
And that also, from what I've seen, it depends on the type of property as well. So as of right now, in the last couple of months, any pre-sales that were purchased in the last few years, and a lot of clients who are completing on them, their appraisal values are coming way below what they paid for, because there's so much inventory that's sitting in the market. These are for pre-sale condos, and whatever's selling is moving at a lower price, so it's pushing down the appraisals. So folks are having to come up with more down payment.
And also where the sales are located, right? Like, again, like we, just to the viewer, we're giving like overviews of the market for the greater Vancouver. At the same time, we're also giving, those numbers for all property types. And it really depends what kind of
where you are,
and where they are located.
That's correct.
Those two parameters put together will dictate completely different trajectories from one type of property to another one.
Exactly, because we're talking about just Metro Vancouver. It can be completely different up north. If you look at the Prince George area, things might be selling above the system. So
but right now we're talking, and even within the greater Vancouver, right? Like if you talk about a property, let's say in Whistler, which is considered Greater Vancouver, or if that property, if we talk about a townhouse in Whistler, or if we talk about a condo in downtown, if you add to that the townhouse in Whistler is wood frame, and the condo wood frame built in the 70s, and the condo in Vancouver is built in 2020, and it has a view and everything. Like those two properties do have complete different destinies and market appreciation and market valuation. So again, to the viewer, we are giving like kind of a broad idea of the market. If your project is more specific, as it should be, reach out to us so we can determine what is the actual supply and demand level and potential evolution for those property types. But yes, like there are a lot of micro markets, and actually I do have that question sometimes. How is the market doing? Well, what kind of market are we talking about?
Exactly.
So
So
right now we
kind of
do
like
a broad approach.
exactly the kind of like the question you asked me. What are the rates like? Well, it depends. What kind of mortgage are we getting you? So
Indeed,
yeah.
yes. Very good. Well, do you have anything else for us in your presentation?
So yeah. So another thing that I want to do a little bit of a case study I made up here. I want to other things that people want to should be aware of in these high interest days is choosing your amortization, knowing the difference between 25-year and 30-year amortization.
Oh yeah, cost of financing associated to that choice.
Yeah, because if you get a 25-year amortization, your interest rate is cheaper and your cost of borrowing. A lot of folks don't look at the cost of borrowing.
It's the most. That's myself. That's the number one thing I look at. How much is it going to cost?
How much is it going to cost you? Not just now, over the period of ownership. So over here, I have just shown an example of a 5-year fixed with 25-year amortization. $750,000 purchase price, 20% down. That's $150,000. That makes your mortgage $600,000. We're doing 5-year fix, 4.24 interest rate. I've just taken a normal, just an estimate number. Don't hold me to it. So based on 4.24 5-year fix, $600,000 mortgage, your monthly payment is $3,234.67. This you also have to remember there's always property taxes, heat. If you have a strata property, there's other expenses. So this is just focused on the mortgage payment.
Okay.
And then there's a further breakdown of your principal. Mm-hmm. So at that rate, your principal is $1,133. So every payment that you make on a monthly basis goes towards paying down that $600,000 mortgage.
Yeah.
The remainder, $2,102.51, goes towards the debt servicing. That's the interest rate. Okay, so at this rate, over the 5-year term of the mortgage, you will have paid down $75,514 of the principal. So $600,000 minus 75. Your balance at the end of term, when your renewal comes up, will be $524,000.
Okay, and then to be clear, the mortgage cost is $118,000.
$118,000 in interest is what you would have paid over the 5 years.
Or the cost of financing.
Yes.
Okay. So that's for 20. I like that a lot. Thank you so much, Piyush. I like that a lot. So I can't wait for the next slide if you go on a 30 years amortization.
30-year amortization. So now, why would somebody do 30-year amortization?
Because it's a lower monthly payment, so they qualify better for the debt servicing ratio.
Exactly. So, because there's other things that you have to look at that the government regulates. You have to fit the debt servicing ratios: 39% GDS and 44% TDS.
Yeah.
But there are certain banks who let you go above, depending on if you have many other factors. Good credit is obviously necessary, but excellent credit. Do you have fallback? Do you have more bank? Do you have extra cash that's sitting in the bank account? Or are you using every single penny you have towards your down payment, and now you don't have anything else in the bank? So there's certain other factors that folks look at. So, but we will stick to the set guidelines. So the exact same numbers. The only difference is now I am using 30-year amortization. With the 30-year amortization, your payment goes down, and now it helps you qualify for the mortgage. As compared to 25-year amortization, you would not have qualified because
what was the monthly payment difference for 25? So 32, 34.
Yeah.
And now if we bump to 30 years amortization,
it's $29.35.
So $300 less.
That's $300 less.
So pretty much 10%.
Mm-hmm.
On the monthly payment.
Yeah, on this particular example, like one thing I will point out, I just wanted to show the difference. So I kept the interest rate the same. Typically, if you were going on a 30 amortization, that interest rate would be increased by 10 points. So it would be 4.34.
Okay.
So, okay, oops.
Not yet, not yet.
I know. Oh,
Oh, we lost the case study. What was
oops.
the I think the overall financing cost was 120,000.
Yes. So in compared to that example previously, in the 25 amortization, you paid down $75,000 in principal.
Yeah.
With this, with 30 amortization, you only paid down $55,000 in principal. That's a $20,000 difference.
Yes.
And then the interest paid over term is increased to 120,000.
120,000, and in the 25 years amortization, it was 113.
118.
18.
Yes. But do you see how you pay down less principal?
So you had pretty much the same amount, like, okay, $2,000 difference
Yes.
in terms of cost of financing, but you don't pay as much towards principal. That's
Yes.
interesting.
That's how it works. So when you extend the amortization, you qualify for the mortgage that you want, but you're paying down much less in principal.
And the cost of financing is almost the same, like $2,000 over, 120,000. We're talking 1.5.
Yeah.
Or something.
And then your balance at the end of term is 544,000.
Wow. Okay.
Compared to 524,000 if you go for a 25-year amortization.
Interesting. Well, I didn't see it coming. Thank you so much, Piyush.
You're welcome. Yeah, and you know what? For a lot of folks who don't have an option, without the 30-year amortization, you would not be able to qualify. Before they used to have amortizations that used to go up as high as 40 years.
If I can add to that particular case study, you took the example of a property that was worth $750,000, which you can aim for 2-bedroom property for that price in the Vancouver and surrounding cities, not too far off, not 40 minutes driving from downtown Vancouver. So with 750,000, again, you can aim for 2-bedroom, which the rent for that 2-bedroom would be $3,500 a month. So now
Downtown,
you pay $2,900 something a month towards your lender for your financing.
Yeah, and then Strata's probably going to be
the maintenance, the tax, the insurance, which basically ballpark is going to be pretty much $1,000. So for basically your trade-off, as opposed to pay $3,500 a month, now you're paying $4,000 a month. But you're paying yourself.
Yeah, and if you rent, if you're renting it out, then you have somebody else paying your mortgage. You're just covering the property tax and strata, and any other maintenance costs. So let's assume, like you were saying, let's go with $1,000 a month. That's about $12,000 a year that's going to come out of pocket, versus everything else, mortgage and mortgages getting covered by the tenant.
Yeah, those are for potential investors.
Yeah.
All right. Well, I think it's been a lot of information.
Oh yeah.
A lot of numbers going all over the place.
Hopefully we don't lose anybody.
Yes, I hope so too. Okay, well, very good. If you want some clarification, if you need further guidance or analytics, please reach out to either Piyush or myself. Piyush, please say your contact info.
Yep. So my name is Piyush Agrawal. You can contact me on Instagram if you want, mortgages.piyushagrawal. That is Piyush is spelled as Piyusagrawal. Otherwise, you can also reach me via my phone number. I don't know if I should give out my phone number on the internet.
Up to you. Up to you.
Hit me up. Slide into my DMs on Instagram.
Go on the ground to find Piyush. Follow him. He's got a lot of valuable info out there. Myself, if you're looking for my handle, is Julien.realtor, JULIEN.realtor on the gram. Otherwise, email me info@julien.realtor, and I'll be happy to help you make your real estate project a success. Well, thank you very much. Enjoy the spring. Sun is around the corner.
Yes, sir.
All right. Piyush, thank you so much.
Take care.
Take care. Bye-bye.
All right.